Good evening, students. Welcome to the session. So today we are going to start a new topic, which is chapter 6A, deduction. Just write it down. Okay. So now this topic is going to be in two lectures, today and day after. Not day after, sorry. It's on then directly Monday. So we are going to discuss the chapter 6A, deductions. Okay. So yes, good evening, Namrata. Good evening, Viraj. Good evening, Sailesh. So this is going to be a very small topic, but as I said, that there could be implications in the total income question. An individual question is generally not targeted on the chapter 6A deduction. So you will obviously spot these deductions as a part of your total income questions. Okay. And yes, there are profit linked deductions which are there, which is under ATIA, ATIB, on which there are certain case laws also, but that we'll discuss on Monday. And plus that would come as like a separate independent question as well. So that is something which is like very, very important. Then ATP, which is going to be there, one profit link deduction, that we will cover it mostly with the cooperative societies chapter. Okay, so with this background, let's just quickly start. So I'm going to cover the deductions in two segments. Okay, so just write it down over here. Chapter 6A, deductions, in two parts. Part one is the investment or the expenditure based deductions. And the second part is the income based deductions. So today we are going to cover the investment or the expenditure based deductions, and then in the next lecture we will be covering the expenditure based deductions. Sorry, income based deductions. Okay. So let's start with it. Income based, or sorry, investment based deductions. Now all of this, other than the income based deductions, you have done as a part of your IPCC syllabus as well. So you are going to give me the answers. So yes, what is covered under ATC, students? What all is covered under ATC? And first of all, before we even proceed further, tell me that what is the need of giving these deductions? Why these expenditure based and income based deductions are given? What is the need? First of all, let's not even get into ATC. First, let me just discuss like what is the need of giving these deductions? Why these deductions? There has to be some reason. There has to be certain logic. Yes. What is the reason? Yes, students, faster. Yes, I'm not getting any answers. Yes. To encourage savings. Yes, Shiva, you are correct. So basically, the expenditure-based deductions are granted to encourage the taxpayers to make the investments or to promote certain kind of investments. And why the income-based deductions are granted? Income-based deductions are granted in order to incentivize certain sectors. So it's not on all the income categories, but these are on the certain sectors which are there. So in order to incentivize those sectors, the income-based deductions are granted. For example, to the infra projects, to the housing projects. In order to incentivize these sectors, these deductions are granted as the income-based deduction. So basically, the entire income will be considered as deduction under section ATIA, IB, IC, which we will see in the next class. Yes, Namrata, correct. So to promote the investment in that particular segment. Okay. Now, first of all, even before we move to ATC, there is one more section which I would like to talk about. Let me first deal with that, which is section ATA. So ATA provides that in computing the total income of the assessee, there shall be allowed the deductions from ATC to ATU from the gross total income. So first you calculate your GTI and then you get the deductions. And the deductions cannot exceed the GTI, meaning you cannot get more deduction even if, let's say, for example, I have income of 1 lakh. I have invested 2 lakh in LIC. I will get only up to 1 lakh. I cannot get additional deduction over and above my gross total income. So the income cannot go negative because of the assessee cannot have a loss situation because of the deduction under Chapter 6A. So Chapter 6A deductions are restricted only to the extent of the gross total income. Can you tell me what is the difference between the exemption and the deduction? Yes. What is the difference? What is the difference between exemption and deduction? Yes, students. Faster. Yes, Mohammed, correct. Exemption is not included in the income and yes, Viraj, correct. Deduction is first included, Namrata, yes, right, and then deducted. Yes, very good. Yes, Geeta, exemption is not covered under Chapter 6A, they are exempted fully. So fully or partially, that is different story, but any which ways, exemption, the income does not come into the total income, whereas for the deduction, it goes to the total income and then you get the deduction. So again, if you look at the section 80B, that also says that the gross total income will mean the total income, which is first computed without taking any deductions, and then the deductions will be applied. So initially in the gross total income, you will first calculate as the income as per all the heads of income. Then you will do the clubbing provisions, what you already learned. Then you will apply the set off and carry forward of losses. You will apply the unabsorbed business losses or unabsorbed depreciation. And that will give you the gross total income. And then you will get the Chapter 6A deductions. Now section 80A and then the rest of the section 80AB, 80AC. That we are going to deal when we are going to cover the profit linked deductions. So now I'm just covering the deductions against the gross total income. For now, 80A just says this. Then we will again get back to 80A when we will go to profit linked deductions. So, investment or expenditure based deductions. Yes. Now first is ATC. What all ATC covers? Yes, students. Namrata, the logic of adding first the income and then deducting is, see Namrata, the deduction which is there, okay, that is not only for the incomes, it is also for the expenditure. And what is the logic of the income based deductions? That first we are adding the income and then providing the deduction. That you will learn when you will see the income based deduction computation. So, in order to compute the tax rate correctly, okay. So what happens is first in order to compute the taxes properly. What happens is, let's say for example, I have an income. Now, first I will include it in the gross total income. I will also have the losses. I will also have the losses. I will have the clubbing provisions. So in that particular case, I have to apply all of that also against the gross total income. And then comes a situation when you get the Chapter 60 deduction. So there you will understand the logic when we will see the profit link deduction, that why we are not exempting it directly and why we are adding and then deducting. But as far as the expenditure based deductions are concerned, understand one thing. See, this is the expenditure based deduction, meaning you invest, you get the deduction. So now your income is already included in the total income. Your income is not exempted or income is not going to be deducted for the expenditure based deduction. What is going to be deducted is the expense you are making, and that expense is allowed you as the deduction. But for the income based deduction, as I said, you will understand when we will see the computation, and at that point I will again get back to your question as to, and you will understand by yourself also that why we are first adding and then deducting. Because that is the entire game of the computation of those kind of deductions under ATIE, ATIB and ATIC. But a very good question. Yes. What is covered under ATC? Yes, students, faster. Whatever you remember under ATC. Yes, students. Yes, Geeta. LIC premium, PPF, NSC, annuity premiums. Yes, very good. Okay, let me discuss then. So what all is covered under ATC? The first is contribution to the ULIPs. Now, when I say ULIPs, what do you remember? What do you remember for the ULIPs? Yes. What do you remember for the ULIPs? Yes, Telish, correct. Yes, Geeta, redemption of loan also. When I take the name of ULIPs, what comes to your mind along with ATC deduction? Two things should come to your mind. Let me see who answers. Yes. What comes to your mind for the ULIP? Yes, students. Yes, Sandhya. Very nice. The premium should be less than 2,50,000. Plus, there was one more condition, Sandhya. Yes, Geeta, good. There will be capital gain if the premium paid is more than rupees 2,50,000. Yes. Ahmed, not the LIC premium. The ULIP is different. Of course, the LIC premium also has the similar provisions, but the ULIP, there is difference. ULIP get taxed and the capital gain. Yes, Shiva, very good. The capital gain provision, isn't it? So for the ULIPs, of course, you get the deduction when you contribute to the ULIP. Now, the deduction which is provided in ULIP is basically not only for the self, it is also if you take the ULIPs in the name of your spouse or the children, or in the case of HUF, any member. So, contribution to ULIPs in the name of self, spouse, children, or members of HUF in case of HUF. So not only you get the deduction, but at the same time, you also get the capital gain. There is an exemption as well, which is the exemption under section 1010B. What is the exemption saying under 1010D? The amount received. So when you contribute to the ULIP, you get the deduction. The amount that you receive on the maturity of the ULIP, that amount will be exempt if the premium is less than rupees 2.5 lakhs, plus the premium should be less than the 10% of the capital sum assured. In case the premium exceeds 2.5 lakh, then that will be considered as a capital asset under section 214. And if it is considered as a capital asset, then you will have capital gain under 45(1)(b), which is A minus B. What was A minus B? A minus B was, A was your amount received. B was the premium paid. Then we also solved so many examples which were given by the CBDT to examine as to how the calculation will happen for the exemption under 1010D. Do you remember that? So you have to consider the aggregate premium of all the policies in all the years taken together to see that the 2.5 lakh threshold is not crossed. Do you remember that? Yes. So that is something you will write it over here just to make a cross reference. So amount received on ULIPs premium paid if it is greater than rupees 2.5 lakh and premium greater than 10% of sum assured. If it is yes, then you have the capital asset under section 214. Capital asset under section 214 and plus capital gain under section 45(1)(b), which is A minus B. And if your answer is no, then in that case, exemption under section 10(10)(3). Yes, students. Fine. Next, what is covered under ATC is under ATC, the premium paid in respect of LIC. Premium for LIC. LIC premium. Now this can be on the life of self, spouse, or the children. Self, spouse, or children, or member of HUF or the HUF. Fine. Now, as I said, in the case of the LIC as well, there is the criteria of the premium paid. So, the deduction will be given to you. The deduction will be given under section ATC, provided the premium should not exceed 10% of the sum assured. So, here there is a condition. For the ULIP, there is no condition on the premium paid, although there is condition on the amount received. But for the premium paid in respect of the LIC, there is a condition with respect to the sum assured. The premium paid should not exceed the 10% of the sum assured. So just write down 10% of sum assured or 15% in case of or 15% in case of the disability. Fine. So there is an additional condition. First is the ULIP, which is their unit linked insurance plan. And second one is the life insurance policy. Are we clear? Now, what else do you remember for the life insurance policy? Yes. Yes, students. Yes. Yes, Mohammed. That is correct. In case of death, fully exempted. No, Geeta, I was not on that point. I was asking regarding the similar provision which is there for the ULIPs, the amount that is received on the LIC, the amount received on the life insurance policy. What did we discuss in the income from other sources class? Yes. Yes, Geeta. Very good. So the limit is of 5 lakh rupees. Unlike ULIPs where the limit is 2.5 lakh, for the LIC it is 5 lakh and that is chargeable under the head income from other sources. Geeta, 1 lakh is not exempt. Up to 5 lakh it is exempt. So you can just write it over here. Amount received on the life insurance policy premium paid greater than rupees 5 lakh plus premium greater than 10% of sum assured. So 10% or 15% in both the cases in ULIP as well as here. If the answer is no, then there will be exemption under section 1010D. However, if the answer is yes, then in that particular case, this will be taxable under income from other sources under section 5630. So this is again A minus B. Yes, students. This also we have done under the income from other sources class, right? And yes, you are correct that the amount that is received on the life insurance policy on the death of a person. So on the death of the person, the exemption will be there. Also under 1010D, keyman insurance policy is not covered. So remember I told you that under 1010D, when we were dealing with the income from other sources class, what did I tell you? That under 1010D, the keyman insurance policy is something which is not covered. So that is any which ways a taxable income. So the amount received on the keyman insurance policy is directly upfront taxable. Clear? So in the 1010D, that is something which is not covered. Yes or no? So for the LIC, you will remember these particular points. Fine. So first of all, here also the circular which is there for the ULIP or the LIP similarly will be applicable. Clear? Similarly, that will be applicable. So you can just write down over here. Sum received on the death of person is exempt. Sum received on the death of the person will be exempt. Without any limit. And as far as I said, in regard to the keyman insurance policy, that will be considered to be a taxable receipt. Okay. So sum received on keyman insurance policy is not covered under 1010D. That we have already taken care under the income from other sources. If you remember, we made a chart there. Okay. Next one is the premium paid. Next one is the premium paid in respect of a contract for deferred annuity. So, premium paid for contract of deferred annuity. So, any premium which is paid for an annuity on the life of individual, so that, is he or his family just gets the pension which is there. So, then in that particular case, that contribution which is paid for the contract for deferred annuity, either on the life of the individual or his spouse or children, provided the contract does not contain any provision for the exercise by the insured person of an option to receive the cash payments at the moment in lieu of the payment of the annuity. So therefore, that particular contribution will be considered as a deduction. Then similarly, it is there also for the government employee when the government contributes on behalf of the employee from the salary with regard to the deferred annuity for either the spouse or the individual or his children. Okay. So again, that is something which is allowed as a deduction. Then contribution is here. You can just write in case of government employees. This shall be restricted to the 1/5 of the salary. Fine. Next one is contribution to the RPF, superannuation fund, and the public provident fund. So again, that contribution is allowed as the deduction. Now, can you tell me whether this is the employee's contribution which is allowed as deduction or the employer's contribution is allowed as a deduction? Yes. Whether it is the employer contribution or whether it is the employee contribution. Namrata, contract of not default annuity, it's deferred annuity. A deferred annuity means the pension payments that you get. So there's a contract which you enter into with, let's say, an insurance company that, let's say, I will die. My family will get the annuity payments. Annuity is periodical insurance, periodical pension payments, basically. Yes, whether it is employee contribution or the employer contribution. Yes, Sandhya. Yes, Namrata. Yes, Mohammed. Mufida, no. Geeta, yes. Selish, yes. Right. All of you have given Shiva right answer. So, yes, it is the employee contribution. So, the contribution which is made from my account. The employer contribution is any which ways considered as a part of my salary, but that is exempt. The employer contribution is not taxable up to 12% under RPF. So employer will obviously not contribute to PPF. PPF, you only make the contribution. There is no equivalent contribution by anybody else. The employer will either contribute to the superannuation or to the RPF. So up to 12%, if you remember, the contribution is exempt of the employer. As far as the ML, the total contribution up to 7.5 lakhs. But in case of the employee contribution, you also get a deduction of the employee contribution under ATC. So this is the employee contribution by the employee and not the employer. The employer contribution is covered under section 14 to 17, under section 17, but up to 12% or 7.5 lakh, that is exempt, the employer contribution, isn't it? Similarly, in the hands of the employer, the amount that is collected from the employees, that is considered as the income, and if he deposits the amount before the due date of the fund, then only it is allowed as deduction under 36(1)(5)(a). Right? And his contribution is allowed as deduction under section 36(1)(4), read with section 43B, that when he contributes the amount before the due date of return of income. Okay, so you can just write it over here for your referencing. Employer contribution exempt up to 12% of my salary. The employer contribution is exempt up to 12% of the salary. And 7.5 lakh. So up to 12% of the salary, and then there is the new limit which has been added, which provides that there will be the exemption, which will be basically up till 7.5 lakh. Okay, so just write it over here. Plus 7.5 lakhs. So beyond 7.5 lakh, the employer's contribution to the EPF, NPS, all of that, or SAF, all of that will become taxable. So the contribution made by the employer to the employees is tax-free up to 12% of the salary. Now salary here means my basic plus the dearness allowance, right? And there is an upper cap of 7.5 lakh on the aggregate of the contributions. on the aggregate of the contribution. So any amount in excess of 7.5 lakh contributed by the employer to these accounts shall be treated as a perquisite in the hands of the employer. Okay. So beyond that, perquisite. An employee contribution is deduction under section 80C. This is in the hands of employee. In the hands of the employer, the employer contribution will be deduction under section 36(1)(4), read with section 43(b). So you will get the deduction of the employer contribution. Up till what amount? There is no limit as such. Isn't it? So you get the deduction under section 36(1)(4). And that you will get only when you pay before the due date of filing the return of income. Right? And the employee contribution, this is the deduction under 36(1)(5)(a). If deposited before due date of the fund. So first, consider income under section 224(10) less deduction under section 36(1)(5)(a). So this is how you should be remembering the provisions. Okay? By interlinking everything. Are we clear, students? Okay, are we clear? Fine. Next one is the contribution which is made to the Sukanya Samriddhi account. So amount deposited to Sukanya Samriddhi account. So any subscription to the Sukanya Samriddhi account in respect of any girl child would be eligible as deduction under 80C. Similarly, if case the amount is withdrawn from such account, that amount will also not be considered in the total income. So, any interest or any withdrawals from the account are also exempt under 10(11)(e). Amount withdrawn, including the interest, is exempt under section 10(11)(e). Then, subscription to National Savings Certificate 8. So, subscription to National Savings Certificate 8 is again allowed as the deduction. Then, subscription towards tax saving mutual funds. So there are certain mutual funds which are basically which are notified as a tax saving mutual fund. So in case you deposit into such funds, that will be considered as the deduction. Then tax saving fixed deposit. Tax saving fixed deposit, if it is opened up then in that particular case, that is also considered as the deduction. Then next one is the payment of tuition fees of any school, university, or educational institution for full-time education, not a part-time. It should be a full-time education for education of for education in India to any university or college or school for 2 children. So this is restricted up to 2 children. And this cannot be for the purpose of any donation or for any development fees or any sports fees which are being paid. This has to be only for the school, college, or institution within India. It cannot be a fee for the foreign university. Fine. And this is only for 2 children. Next is repayment of housing loan. Repayment of housing loan. Now this will include even the stamp duty, including the stamp duty, registration fees. Okay. So any payment which is made towards the cost of purchase or construction of the house property. Now this could be the self-financing cost, or this could be the loan borrowed for which the repayment is being made. So that is something which is considered as the deduction. So cost of purchase or construction, repayment of housing loan, excluding the interest, claimed as deduction under section 24. Okay. Then stamp duty and registration. This will not include any cost of repair, renovation, or any interest amount which is allowed as deduction under 24. So that is not something which is included. Fine. Then next one is NABARD bonds. So if we subscribe to the NABARD bonds, then that is also considered as exempt. That is also allowed as deduction. Next one is investment in post office deposit. Now this should be for 5 years period. Similarly, the tax saving FD also should be for 5 years period. Okay. Then contribution to the NPS Tier 2 by the central government employees. Okay. By a central government employee. So these are the expenses or investments which are covered under section 80C. Yes, students, any question, any doubt? Yes. Yes, any questions? Okay. Now, what if I just terminate, let's say, the insurance policy Or let's say I terminate the fixed deposit, or I transfer the house property which is I have purchased. So in these cases, the deduction which has been claimed earlier shall be deemed to be the income of the previous year in which the termination or withdrawal or transfer of house property takes place. So where let's say for example I terminate my insurance contract, okay, by let's say not paying the premium within the period of 2 years after the date of insurance, or I terminate my participation in ULIPs, okay, before let's say 5 years, or I transfer my property before the 5 years from the financial year in which the possession was obtained, or let's say for example where there is a window of 5 years for the post office deposit or for the fixed deposit. In all of these cases, the amount which is withdrawn will be subject to tax. Okay? So just write it over here. If the LIC is terminated in 2 years, so you can just write consequences of termination or withdrawal or transfer. Or if the ULIP is terminated in 5 years, or if the fixed deposit or post office deposit is withdrawn before the 5 years period, or the transfer of house property, or if there is a transfer of the house property within the period of 5 years. From the financial year of possession, then the amount allowed as the deduction, then the amount which is allowed as the deduction will be deemed to be the income. Okay. In case of the withdrawal, amount withdrawn will be deemed to be income. Now, this is not applicable on the death of the assessee. Okay. So, not applicable on the death of assessee if the amount is received by the legal heir. Fine. Yes or no, students? Which point summarize? 10. Okay, repayment of housing loan, Namrata. So if let's say I'm not repaying the housing loan, I'm constructing or purchasing through my own funds, that also the purchase cost or construction cost will be allowed as deduction under ATC. Repayment of housing loan, excluding the interest amount. So principal amount only is allowed as the deduction because interest you have already claimed under section 24. So here you can write it like this. This is principal amount. and stamp duty and registration fees, that also will be allowed as the deduction. Is it clear, Namrata? Yes. So now what is the maximum deduction which is allowed in the ATC, which is 1,50,000. So the maximum deduction which is allowed under ATC is the 1,50,000. Also, remember one thing, you will not get Chapter 6A deductions against certain incomes. Can you tell me what are those incomes that you can recollect against which you will never allow the Chapter 6A deductions? Yes, students, what are the incomes against which you will never allow Chapter 6A deductions? Yes, there are certain incomes against which you will never allow the Chapter 6A deduction. Let me see who recollects. Yes, students. Yes, Viraj. STCG under 111A. Not all the STCG, but STCG under 111A. LTCG under 112 and 112A. Yes, right, Viraj. Yes, Sandhya, very good. 115 BAC, 115 BAB. Yes. Yes, Viraj. Lottery income, very good. Yes. So all of these income against this, you will not compute the Chapter 6A deductions. Chapter 6A deductions not allowed against lottery income, STCG under section 111A, LTCG under section 112 or 112A. Then there are many other special income sections which are there, which is if you do not opt out of 115 BAC. So for that, you will not get the Chapter 6A deductions. BAB, BAA, BAD, right? All of these will not be eligible for Chapter 6A deductions. Of course, you have certain deductions which are allowed, which is 80JJAA and 80LA. These are the two deductions which are allowed. 80JJAA and 80LA and 80CCD 2. So these are the deductions which are only allowed. Fine? Yes, correct, Viraj. Income from race, horses, crossword puzzle, all of that. Now we move on to the next section, which is deduction in respect of the contribution to the pension fund under 80CCC. Contribution to the pension fund. So let's say, for example, when an individual has deposited the amount to any pension fund, right? In order to, so basically these are the funds which are like, LIC only. But here the LIC or any other insurer will give you the pension. Okay, will give you the pension after the certain number of years are completed as per the policy. Now that is allowed as deduction under 80CCC. So under 80CCC, this will be allowed as the deduction. Okay. And if, let's say, for example, any amount which is there is received on the surrender of the policy, is received on the surrender of the policy, then in that particular case, such amount will be deemed to be the income of the assessee as well as his nominee when the amount has been received on the surrender of the policy. Okay, so just write down amount received on surrender of the policy, amount received on the surrender of the policy by assessee or the nominee or the pension received. Both of these will be considered as your income. Both of will be chargeable to tax as income. Next one is 80 CCD, which is the pension scheme or contribution to the pension scheme of the central government as notified by the central government. Now, let's understand this particular thing. This is little different from what you have studied till now. Under 80 CCD, because there are different things over here. So let's try and understand. Now, in the case of the contribution to the government pension scheme, in the case of contribution to the government pension scheme, this is allowed as the deduction. Now, the employee contribution will be allowed, as I said, even for the LIC or any pension scheme which is there, or sorry, even for the RPF which is there, or PPF which is there, the RPF and SAF which is there, the employee contribution is allowed as the deduction and not the employer contribution. But here under 80 CCD, you are allowed the employee plus the employer contribution. Under 80 CCD, you are allowed the employee plus the employer contribution. So just make a chart for this. So employee contribution, and this is my employer contribution. Now, as far as the employee contribution which is concerned, so 10% of the salary, 10% of the salary is allowed as the deduction. Maximum 10% of the salary. So amount deposited or the maximum 10% of salary. Whichever is lower. Fine. And in the case of the self-employed individual. So in the case of the self-employed individual, this shall be the amount deposited or 20% of the gross total income. Because here you do not receive salary, so it cannot be 20% of salary. Whichever is lower will be allowed as the deduction. So 10% of salary in the case of the employee and 20% of the gross total income in the case of the self-employed individual. That is one. Now coming to the employer contribution which is there. Now, as far as this is allowed, see, employee contribution, which is there, is allowed under section 80 CCD 1. The employer contribution, which is there, so that is allowed under section 80 CCD 2. Now, this also would be allowed as the deduction, but this will be again in the case of government employee, whether state or the central government, this will be restricted to 14% of the salary. This will be restricted to 40% of the salary. Now here the salary means of course, basic plus the dearness allowance, even in the employee's contribution. And in the case of any other employer, this shall be 10% of the salary. Restricted to 10% of the salary. Are we clear? Then here one more deduction which is given beyond the 80 CCD 1 and 80 CCD 2. And what is that? The National Pension Scheme. National Pension Scheme, if you contribute to the National Pension Scheme, this deduction is allowed up to rupees 50,000 under 80 CCD 1B. Restricted to rupees 50,000. So amount deposited or the 50,000, whichever is less. Are we clear? Now, if you look at it, if you look from the overall limit perspective which is there. So in the case of the 80C, 80CCC and 80CCD1, all the three are subject to the limit of rupees 1.5 lakh. So there's an upper limit of rupees 1.5 lakh under 80CCD. Okay. So my 80CCD1 so just write over here. So 80CCD1 plus 80C plus 80CCT maximum up to rupees 1.5 lakh. Maximum up to rupees 1.5 lakh under section 80CCE. So this means the employer contribution which is there, that is over and above the 1,50,000. So this amount not capped by 80CCE limit of rupees 1.5 lakh. Similarly, the NPS contribution of 50,000. This is also over and above 1,50,000. So this is also not capped by 80CCE limit of rupees 1.5 lakh. So that means the employer contribution to the NPS and the employer contribution to the pension scheme and the NPS are over and above the limit of 1.5 lakh. Additionally, the 80CCD2 is available to an individual irrespective of whether he is going for 115 BAC or normal scheme of taxation. Namrata, the self-employed, is covered under this section in order to incentivize him to contribute to the pension schemes. Okay. So you can just write down whether covered under concessional tax scheme under section 115 BAC. This is no the employee contribution, but yes, the employer contribution is covered. And the NPS is not covered. NPS is not covered. Okay? Yes or no? Now, what if, let's say, for example, you close the account, pension account, or you opt out of these schemes, or there is a pension that you are receiving on the closure or the opting out? Then, in that particular case, the amount which is there in the pension account will be taxed as the income in the year in which the amounts are received by the assessee or his nominee. So let's say, for example, if you're closing the account or if you are opting out of the account. So let's say, for example, in case of closure or opting out, the amount or the balance in pension account, the balance in the pension account and the amount which is withdrawn. Okay, so balance in the pension account, including the interest, deemed to be the income. It shall be deemed to be the income in which the amounts are received by the assessee. In which amounts are received by the assessee. Closure or opting out of the pension account or the pension scheme. However, in case the amounts are received by the nominee on the death, then that is going to be exempt. So, in case amount received by nominee on death, then this is not taxable. And this is not going to be taxable. Now, this is the scenario when the closure or opting out happens in case of the pension account. Now, what happens in the case of the NPS? Let's say, for example, if the NPS is withdrawn on account of the closure or on account of the opting out of the pension scheme. So then in that case, in case of, first write down the NPS on account of NPS withdrawal first is on the closure or the opting out. In case of the closure or on case of the opting out, then section 1012A provides that to the extent 60% of the total amount which is payable to the assessee on the closure or on the opting out shall be exempt from tax. So 60% exempt and 40% is going to be taxable. So out of the amount which is withdrawn, the 60% will be exempt and 40% will be taxable. However, in the case of the partial withdrawal, so this earlier one is other than NPS. Okay. In the case of the partial withdrawal from the NPS, section 1012B provides that any payment from NPS to an employee under the pension scheme on partial withdrawal, then up to 25% of the contribution will be exempt and balance 75% will be taxable. So partial withdrawal, this is section 1012A and this is section 1012B. So in case of the employee, %25 of contribution is exempt, 75% is taxable. Okay. Then in the case of any other person, so for the employee, you have the limit of 25% exempt, and for the other person, if there is partial withdrawal, that will be completely taxable. So only in the case of employee, 25% is exempt. Yes or no, students? Yes, any questions, any doubt? Yes or no? Okay. The next deduction is 80CCH, which is a new deduction. So 80CCH. This is only, contribution to Agnipath scheme. This is in respect of, there's a new scheme which is there. So contribution to Agnipath scheme. It is not a movie, it's a scheme. Agnipath scheme. It's a central government scheme which is launched for the Indian youth in the armed forces, in the Indian armed forces. So in case there is a contribution which is made to the Agnipath scheme, then under 80CCH, the deduction will be available of the amount of contribution, either to the corpus of the fund also, then also this will be eligible. Okay. Yes. So let's say, for example, this amount provides for the amount deposited by the assessee who is subscribing to the Agniveer corpus fund. Now the whole of the amount of the contribution is allowed as the deduction. So this is going to be the contribution by the assessee. The employer, the central government employer is also contributing. That would be included in the salary. And then again, the deduction under 80CCH will be available. Okay. Now under 80CCH, the deduction will be available. Under 80 CCH, the deduction will be available only when you do not go for 115 BAC. Okay? So here you will get the own contribution 100% and central government employer contribution also 100%. But this is not available if 115 BAC is not opted out. However, this employer contribution will be available even under 115 BAC scheme. So this 80 CCH employer contribution also you can write down over here. So 80 CCH. That is the new section which has been introduced very recently, which is 80 CCH, which is Agniveer contribution, which is only for the armed forces. Okay. Yes or no? Any questions? Any doubt? Yes? Okay. With this, we'll take a small break of 10 minutes and then we'll get back and start with 80D onwards. Okay. So let's take a break of 10 minutes. ब्रेक स्टार्ट करें. अशोक जी ब्रेक. there is no limit for 80 CCH. There is no limit. Whatever you contribute, that will be allowed. Okay, students. So let's proceed further. Next, we are going to deal with the section 80D. Next is section 80D. 80D is what? Medical insurance or the expense. Okay. Now, under 80D, there are different limits for the senior citizen and a person who is not a senior citizen, right? So, first is for the individual. Just write down. In the case of the individual. Now, in respect of the individual, let's say, for example, if he is making the payment of the premium. So, any medical premium paid, otherwise than by cash. It should not be in cash. Okay. Then this could be on in the case of the individual for himself, for his spouse, and for the dependent children. So for individual, for self, spouse, or dependent children. In the case of LIC premium, what was the LIC for? For self, for spouse, and for children, whether dependent or independent. So, in the case of the medical, it is only dependent. You can write it here, a cross-referencing. For LIC, even independent children covered. Got it? But in the case of medical premium, only the dependent children. Second is the preventive health checkup expenditure. Preventive health checkup expense, either for self or for the spouse or for the dependent children. Now, in this particular case, for the preventive health expense checkup expense, it is rupees 5,000. Just write it like this. This is rupees 5,000. And the overall deduction, including the medical premium and the health checkup. So health checkup, you get 5,000 maximum. But the overall deduction for both of them will be rupees 25,000. Sorry. Will be rupees 25,000. Including the medical expense. So let's say, for example, my health insurance premium is 25,000. My preventive health checkup expenditure is 5,000. So then in that case, I will get a deduction of 25 and not 30,000. So 5,000 is included in the overall limit of 25. Now, preventive health checkup expense can be in cash. The medical premium has to be otherwise than by cash, but the health expenditure or health checkup expense can be in cash. Are we clear? Then, in case, let's say, for example, I or my spouse or my children are above 60 years, then in that particular case, the limit is rupees 50,000. If the insured is greater than equal to 60 years plus a resident in India. So he should not only be more than 60 years, but he should also be a resident of India. Then in that case, I will get the deduction of rupees 50,000. Clear? Then the second one is premium paid, medical premium for the parents. So that is the additional amount that you get as deduction. So any premium paid for the insurance of the both or either of the parents. Okay? Including the preventive health checkup expense, which is again your limit is 5,000, additional 5,000 you will get. Then for them, the deduction is 25,000. However, it will be 50,000 if insured is greater than equal to 60 years plus resident of India. So this is for the parents. Okay, this is for the parents. So, but as I said, the preventive health checkup, the maximum deduction is 5,000 for the aggregate for myself and for my parents. So the aggregate of this 5K is aggregate for B and C and not additional. Okay, so you can write it down. Total preventive health checkup expense for self, spouse, dependent children, or the parents cannot exceed rupees 5,000. Are we clear? Yes or no? So in case of individual, the aggregate of deduction is available is 25,000. If he's a senior citizen, then 50,000. Plus he will get additional 25 or 50,000 for his parents. The third one is medical expenditure. Medical expenditure for self or spouse or the parents who are greater than equal to 60 years, plus resident of India, plus they are not covered by any medical insurance. Then in that case, they are allowed, instead of this particular limit, they will get 50,000 for the medical expenditure. So the overall limit for C and D cannot exceed 50,000. So this 50,000 is not additional, but in substitution of either A or either C. Okay. So you can write here A plus D should be less than 50K, or C plus D should be less than 50K. So if it is for parents, then the parents, so let's say for example, I have one parent who is having the medical insurance of 25. He's a senior citizen. For another parent, I have the medical expenditure of 75, who does not have any medical insurance. But then the overall limit will not be 75 plus 25. It will be combined 50. Yes or no, students? Any questions? Any doubt? Yes. Then in the case of HUF, in the case of HUF, for HUF, again, it is the same. For the family member, for the family member, the medical premium other than in cash. Secondly, the preventive health checkup expense. So, for the family members, the limit is, for this, it is 5,000, but the overall limit is 25K or 50K for greater than equal to 60 years plus the resident of India. Okay, so that is for the HUF. For HUF, there is no provision for the medical expense. Yes, students, any doubt? Yes or no? Will you solve one small question on 80D? Yes? Okay, let's solve one question from your module itself. So Mr. Ravi, aged 45 years, paid medical insurance premium of 22,000 during the previous year 23-24 to ensure his health as well as the health of his spouse. He also paid medical insurance premium of 47,000 during the year to ensure the health of his father, 65 years, who is not dependent on him. He contributed rupees 4,600 to the central government health scheme during the year. He has incurred 3,000 in cash on the preventive health checkup for himself and his spouse and 4,500 for the father. Compute the deduction allowable under 80D. So he's not going for 115 BAC scheme. Yes. Here for the HUF also, sorry, this is available. Medical expense is available. But this is within the overall limit only for the family members. Yes, how will you compute? What is the answer? First of all, for himself what and the spouse, the premium that he's paid, what amount will be available? Yes, students, faster. What will be the answer, students? First of all, for self and the spouse, the medical expenditure is 22,000. So whether that will be available, the answer is yes. So 22,000 will be available. Then contribution to the central government health scheme, 4,600. So how much from that will be available? So the overall limit is 25,000 because he is not a senior citizen. He's 45 years age. Neither his wife is a senior citizen, which is not mentioned here. But assuming the wife also will not be a senior citizen. So then in that case, 25,000 minus 4,600 minus 22,000. So if you look at it, this is exceeding 25,000. So therefore, only 3,000 will be available for central government health scheme. So for self and spouse, 22K plus 3,000 for the central government health scheme. This is for premium. Okay. Then he has also paid in cash on the preventive health checkup of himself and spouse. Whether he will get that, the answer is no. Because we have already exhausted the limit of 25,000. Fine. Now for the father. The medical premium paid is how much? The medical premium paid for the father is, yes, 47,000. So yes, we'll get for the father. The father is a resident in India and senior citizen. So 47,000 for the premium. Then he has also incurred the preventive health checkup. Now, as I told you, the preventive health checkup, the entire limit is 5,000 for either self or for the father. The limit is not exhausted for the self. So the limit of preventive health checkup is not exhausted. So I will get here the 3,000 rupees for the 50,000. So 3K for the checkup expense. So total is 50,000. So total deduction under 80D, deduction under section 80D is 75,000. Let's say, for example, if your central government health scheme was not there, let's say it's not there, and I have paid 3,000 in cash on preventive health checkup. Here I have paid 4,500 for my father. Now what would have happened? I would have only got here in that case 2000. Because 3000, let's say, for example, I've already utilized over here. So I cannot extend beyond 5000 aggregate for me as well as my father. Yes, Sandhya, very good. Are we clear? So this is section 80D. Let's proceed then. The next section is 80 double D. 80 double D is for the maintenance of dependent disabled. Maintenance including medical treatment of dependent disabled. Okay. So basically, this is provided to an assessee who is a resident in India. So ATC is available to all. It is not said that it is only available to a person who is resident in India. Okay. ATC is also available to all. So if you go to ATC, this is available to any person. It is not restricted that this is going to be only available to the resident individual or HUF. It just says that ATC is available to the individual or HUF. Similarly, ATCCC, which is there, which is for the pension scheme, again there is no restriction. Of course, the pensions can usually are made for the resident individual. Similarly, ATCCD, which is there, again, that is for the, again, individual. There is no mention that it is only resident. But here under 80DD, this is available only to resident individual or the HUF. Resident individual or the HUF. Okay. Then what is the amount qualifying for deduction? So any amount which is incurred for the medical treatment or training of a dependent who is disabled, or any amount which is paid to the LIC for the maintenance of the dependent qualifies for the deduction. Okay. So basically either I am incurring the medical treatment expense or I am paying for the policy for, let's say, the maintenance of dependent. Let's say tomorrow if something happens to me, my dependent will get the pension or annuity or some lump sum amount for maintaining himself. Are we getting that? So this is basically the two things which are qualifying for the deduction. Now, the benefit of this expenditure is benefit of this deduction is available to the assessee who is incurring these expenses on the maintenance, and there are qualified diseases against which there is a disability. Now, what is the quantum of deduction? The deduction over here is 75,000 and in case of severe disability, it is 1,25,000. Okay, so deduction is 75,000 and 1,25,000 in case of severe disability. Now, if let's say, for example, I have taken the, I have paid the policy, maintenance policy, I have taken the maintenance policy from LIC for my dependent. And let's say, for example, dependent dies. Then who will receive the amount? Obviously, from the policy, the amount will be received by the individual who has taken that policy. Right? So in that case, the amount which is getting received by me for the policy that I had taken for the maintenance of dependent. Now, dependent is no more. So the amount which is paid to the individual who has taken that subscription would be taxable in the hands of that individual. However, if let's say, for example, dependent does not die, right? And the dependent receives this amount, then in that particular case, that amount will not be taxable. Okay, so just write it over here. If the amount on the maintenance policy is received by the dependent, then it is not taxable. However, if it is received by the individual maintaining the dependent, this shall be taxable in the previous year of receipt. Okay. If the dependent dies before the individual. Okay. If the dependent dies before the individual, then the amount will become taxable. Clear? Next section is 80 DDB. Now this is for the medical treatment. This is for the medical treatment. Again, this is the eligible assessee here is a resident in India. Individual or the HUF. A resident, individual or HUF. Okay, the deduction is available for expenditure on self or dependent or the dependent and for the members of the HUF. So dependent here will be spouse, children. They should be dependent, okay? Or siblings, brother, sister, or the member of HUF. Now here the amount paid for the medical treatment, which are specified medical diseases, then in that case, the deduction will be 40,000. So the deduction will be 40,000 or 60 or 1 lakh rupees or 1 lakh rupees if it is for the senior citizen. If it is paid in respect of senior citizen for individual greater than equal to 60 years plus resident in India. Right? So the maximum deduction is 40,000 or rupees 1 lakh. Here, so you may ask, ma'am, that we have seen that the medical expenditure is there under 80D, the medical expenditure is there under 80DD, and then the medical expenditure is there under 80DDB also. So where exactly we have to take in the exam? See, the medical expenditure for the normal diseases is covered under 80D, but that is available only when the person who is there for whom the medical expenditure is incurred is a senior citizen, is a resident of India, and there is no medical insurance policy for him. He is not covered by any medical insurance policy. If it is covered by medical insurance policy, then they will not get under ATD, you will not get any medical expense. So the primary condition is that you should not be covered by the medical insurance policy. See, many of the clients come and tell you, ma'am, can we get deduction under ATD for the medical expense that we have incurred during the month or during the year? You will have to say, yes, you can get, but only up to 5,000 for the preventive health checkup. If you want to claim 50,000, you, your parent, or your spouse should be more than 60 years for whom you have incurred the expense. They should be resident of India. Plus, you should not have any medical insurance policy for them. You cannot claim the double benefit by claiming the insurance premium also and medical expense also. Because if you are having the medical insurance, obviously your medical expenditure is going to be reimbursed by the insurance company. So then you don't want to, income tax department will not give you the claim of the expense, right? You cannot doubly benefit out of the premium as well and the expenditure as well, when you are also getting the reimbursement from the insurance company. Then under 80DD, you get for the disabled. If there is a person who is disabled for whom you have incurred the medical expense, you get under 80DD. Under 80DDB, there are specified diseases which are very, very serious in nature. For them, if you incur any medical expense, that is covered under 80DDB. Clear, students? Okay. Yes or no? Any question? So these are, first of all, if you see my bucket of the deductions, under investment or expense-based deduction also, if you look at it, the first one was the investment-based, which were 80C, 80CC, sorry, 80CCC and 80CCT. Red with 80CCE. Then we saw the expenditure based, which is 80D, 80DD and 80DDB. There is one more deduction which is in respect of the disabled person. Which is that deduction? 80U. So 80U is the deduction for the disabled person. So deduction in respect of a person with the disability. That is not expenditure based, but a special deduction. Under 80U. Since we are talking about the disability, we are giving them a deduction and we are discussing here only at this moment. So just write down 80U. Deduction for disabled. Deduction for disabled. Here the eligible assessee is again resident individual. Resident individual who is disabled. So this deduction is not given to anybody else but to a person who is disabled. This is because for the disabled, there should be equal opportunities, and for them to give them the equal opportunities, a special deduction has been extended to persons suffering from the disability which are specified. And what is the deduction? Deduction is 75,000 or 1.25 lakh in case of disability greater than 80%. Fine. So that is a deduction under section 80U. Are we getting that? So again, understand one very, very important thing. When, let's say, for example, you are claiming the deduction under 80DD, when you're claiming the deduction under 80DD, then you cannot claim again the deduction under 80U. So let's say, for example, I am claiming the deduction under 80DD for a dependent who is there. For a dependent who is there. Right? So then the dependent again cannot claim the deduction under 80U. So just write it over here. Under 80DD, write down. For the dependent disabled. So for the dependent disabled, the dependent here means spouse, children, sibling, or members of HUF. Not claiming deduction under section 80U. Okay, so you can write it over here. Deduction under section 80DD and 80U both cannot be claimed. Fine. Both cannot be claimed. Either you can claim 80DD as a person who is maintaining the disabled, or the disabled himself can claim 80U. Clear? Okay. So next is the next set of deductions, which is what we are going to do, is the interest-based deduction. Interest-based deduction. In this, we have 80EE, then 80EEA, then you have 80EEB. So these are my interest-based deductions, where I get the deduction for the interest payments that I have been made. So first is 80E, which is deduction for the interest on the education loan which is there. Okay, so 80E is for deduction for interest on loan taken for higher education. Taken for higher education. So that is 80E. So loan is taken for the higher education of self or the relative. Of the self or the relative. Relative here means the spouse and children. Spouse or the children. Okay, and higher education means pursued after 12th. So it could be any university, education, anything. Now, what is the deduction which is available over here? So the deduction which is available over here is, so the deduction over here is the interest amount. Interest on education loan. Okay. And what will be the period of deduction? So my period of deduction will be, it will be for allowed for the 7 assessment years from the initial year when the loan is being taken. Oh, sorry, when the interest has been started to be paid, and 7 assessment years succeeding the initial assessment year. So from previous year, from when interest has been paid, sorry, till 7 AYs. Okay, so it is available for the 7 assessment year. You should not write your previous year, just write assessment year, or just write 7 assessment years from when the interest has been paid. Okay, fine. So this is your ATE. Now what is ATEE? ATEE is interest on loan borrowed for acquisition of house property. Acquisition of the house property. So what are the conditions? There are conditions over here. The first condition is value of house should be less than equal to rupees 50 lakhs. Okay, value of house should be less than equal to rupees 50 lakh. Loan sanctioned should be less than equal to rupees 35 lakhs. Then assessee, sorry, you can write third, loan sanctioned during previous year 16-17. Assessee should not own any residential house on the date of sanction of the loan. On the date of sanction of the loan. Then in that case, you will get the deduction year of the interest on loan up to rupees 50,000. Up to rupees 50,000. So this is over and above rupees 2 lakh allowed under section 24. Available under section 24. Okay, for the self-occupied property. Fine. So this is over and above rupees 2 lakh. Clear? Next is ATEEA. This is again for the interest on loan for a residential property. Okay, for the residential house property. Here, if you are acquiring a loan, if you are taking a loan for acquiring the residential house property, you get the deduction under 80EE. What are the conditions? Here also there are same conditions. First, stamp duty value of house. Stamp duty value of house less than equal to rupees 45 lakh. So in the earlier scenario, this was value of the house less than rupees 50 lakh. But here they are saying that the stamp duty value less than equal to 45 lakh. Here there is no condition for the loan sanctioned. There is no condition for the loan sanctioned in respect of the amount of the loan. But for the period of the loan sanctioned during previous year 19 to 22. Between loan sanctioned between 1st April 19 to 31st March 22. Then assessee should not own any residential house, same condition. Any residential house on the date of sanction of loan. And the individual should not be eligible to claim deduction under section 80EE. So you will ask, ma'am, why two sections under 80EE? If you look, the loan sanction was prior to 1617. Here they are saying that the loan sanctioned between 1/4/19 to 31st March 22, meaning the properties are purchased between these periods, right? And the stamp duty value in the 80EE is 50 lakh. Here it is 45 lakh. Here, what is the deduction? So deduction will be interest on loan. Deduction shall be the interest on loan up to rupees 1.5 lakh. The deduction will be up to rupees 1.5 lakh. Again, this will be over and above rupees 2 lakh under section 24B for the self-occupied property. Fine. Now, these both deductions are not eligible to be claimed by a person or by an individual who is not opting out of 115 BAC scheme. Right? If you only opt out of the 115 BAC scheme and you go as per the regular provisions of the tax, then only you can claim the deduction under 80EE and 80EE. Clear? So you can just write it down over here. Tax rate regime. Old regime. Default. Concessional tax regime under section 115 BAC. Fine. So, in respect of the self-occupied property or the self-occupied property, under the old regime, the interest under section 24B, interest restricted to rupees 2 lakh. Interest restricted to rupees 2 lakh. Under the concessional tax regime, you are not allowed the interest on the self-occupied property. Isn't it? You're not allowed the interest on the self-occupied property. With regard to the deemed let out property or the let out property, not the deemed let out property, here in the case of the old regime under section 24, there is no restriction of 2 lakh. However, under section 71B, which is set off and carry forward of the losses, loss under IFHB restricted to be set off against other head of income up to rupees 2 lakh. Okay, up to rupees 2 lakh. However, in the case of the concessional tax regime, again, you can claim the deduction under 24B. So, no restriction. Or you can write like this. Can be claimed without any restriction. However, whether set off of the losses is allowed? Yes, students, whether set off of the losses is allowed under 115 BAP. We discussed that day. Will you set off the house property loss against any other income under 115 BAC? Yes, students. Yes, give me the answer. Under the new regime, yes, Mufita, very good. So, under the new regime of 115 BAC, you will not allow the set-off of the losses against any other head of income. Yes, Namrata, very good. So, no set-off of losses against any other head of income. Okay. Then deduction under section 80EEB. Here it is allowed. Here it is not allowed. Okay. So in the old regime, this is allowed up to rupees 1.5 lakh. Up to rupees 1.5 lakh. Whereas in the new regime, you will not get any deduction under 80EEA. Sorry, not B, it's A. Yes, students, any questions, any doubt? Yes. The next one is 80EEB, which is interest on loan taken for purchase of electric vehicle, EV. Okay. So loan taken for purchase of EV. So what are the conditions? The conditions are loan taken on purchase of EV. So it should be sanctioned during loan sanctioned between 1/4/19 to 31st March 23. Second, loan should be sanctioned by a financial institution. A financial institution. It can be a bank, it can be NBFC. Okay. And third is assessee is individual. Assessee is individual. Now, what is the deduction? The interest on loan up to rupees 1.5 lakh. Up to rupees 1.5 lakh. Yes, students. Any question? Any doubt? Yes. Any doubt? Any question? Okay. Yes. Shall we solve one question on that? On the interest on the loan? Okay. Let me just give you the question from the module itself. So there is Mr. Arun, Barun, Chetan and Dinesh. They have taken the loan of 43, 45, 20 and 12 lakh respectively. The loan is taken from HFC, Housing Finance Corporation, NBFC and Public Sector Bank. Date of the sanction of loan is given. Date of disbursement of loan is given. Purpose of loan is acquisition of the residential house property for self-occupation, and Mr. Chetan has purchased for electric vehicle and so is Mr. Dinesh. The stamp duty value is given, cost of electric vehicle is given, rate of interest is given. You are required to tell me deduction under 80, EE, or EEB. Yes. First tell me for Mr. Arun. Namrata, first solve this question, you will understand and I will summarize for sure. Yes, students. Yes, faster. So first of all, whether the conditions under in the case of Mr. Arun are satisfied. Yes, students. So he has taken the loan of 43 lakhs, which is less than rupees 45 lakh for sure. Okay. So which is less than rupees 45 lakh. The loan is sanctioned between 19 to 22. So sanctioned amount is also there. We don't need to concern the disbursement, but it should be sanctioned. So which is sanctioned? What is the stamp duty value of the house? The stamp, there is no condition for the amount of the loan, but yes, the stamp duty value condition of 45 lakh is met. So you will get deduction under 80 EE. What will be the deduction? So 45 lakh is the stamp duty value and the loan amount is 43 lakh. 9% on that comes to 3,87,000. Now, since this is a self-occupied property, you will get deduction under 80EE up to rupees 2 lakhs. Right? This is a self-occupied property, so you will get only the deduction of rupees 2 lakhs. Fine. Then, in the case of 80EE, how much additional deduction will be available? Yes, students. How much additional deduction? Yes. Sandhya? Yes, you're correct. It should be combined 3,50,000. So, Namrata, I'm summarizing it. First of all, there is no condition for the amount of loan taken under 80EE. So, I'm not concerned with that. So, I'm just writing I'm not concerned with that. Where I have taken loan from, I'm not concerned. I am concerned with the date of sanction of loan, which should be between 19 to 22, which is there. Then I'm not concerned with the purpose. I'm not concerned with the date of disbursement. The purpose is only important to identify how much interest will be available under 24 section. Stamp duty value is 45 lakh. This condition is met. So interest under 24B, because it's a self-occupied property, right, will be 2 lakh for self-occupied property. And here they have given, he has exercised the opting out of default tax regime. So of course, I'm just getting this 24B, 2 lakh. And under 80EE, 1.5 lakh, because 3.87 lakh minus 2 lakh is what should be allowed under 80EE, but it will be restricted to 1.5 lakh. So ideally 1,87,000 will come under 80EE, but I will restrict to 1.5 lakh. Is it clear, Namrata? I hope that clears. Next is Mr. Barun. He has taken the loan of 45 lakhs. Now again, the loan amount will not matter to me, how much loan he has taken, right? But the loan is not taken from the financial institution. It is taken from the NBFC. For 80EE, the loan should be taken only from bank or a housing finance company. So under 80EE, the loan which is there, you can write here one more condition instead. Loan taken from bank or the housing finance corporation. NBFC not covered. The NBFC is not covered under 80EE and also under 80EE. So here also you can write loan taken from bank or housing finance corporation. But whereas for 80EEB, here it includes the bank as well as the NBFC. Under 80EEB, it includes the bank as well as NBFC. Are we getting that? So here, this is taken, we should not write not concerned here. This should be, this is met. Here, this is not met. Are we getting that? In the second thing, it is not taken from the bank or the HFC. So 80EE, the first condition itself is valid. Second, stamp duty value is more than 45 lakhs. So this is also not valid. Third, whether the loan is sanctioned between 19 and 22, answer is yes. So two conditions are violated, therefore 80EE not applicable. In this case, it is not applicable. So I will only get the deduction under 24B since this is a self-occupied property, which will be restricted to 2 lakh. In case of electric vehicle, I have taken the loan amount of 20 lakhs. Okay, in case of the electric vehicle, I have taken the loan amount of 20 lakh. Here again, there is no restriction on the loan amount or on the cost of the vehicle. All that they say that the loan should be sanctioned between 1419 and 23. So this condition is met. This is I am not concerned. Here it is NBFC, so this condition is met. This is again not concerned. This is not a concern for me. Again, this is not concerned. So here I will get 20 lakh into 10%. Okay, but the deduction will be restricted to 1.5 lakh. Sorry. 80 EEB 1.5 lakh. And lastly, for Mr. Dinesh, if you look at it, this is not applicable. This is public sector bank. So this is fine. It's a public sector bank. But this is before 2021. So it's not between 21. So this condition is not met. And therefore, under 80 EEB, I will not get any deduction. Okay. Yes or no, students? Have you understood this? Yes. Yes, Namrata. Correct. Okay. So with this, we are ending the interest-based deductions. Now, the next set of deduction is the contributions or the donations. So you can just write contribution-based deductions. Contribution-based deduction, which is 80G. Okay. Then you have 80GG, 80GG, that I will cover separately. That you should write in the next line because that is for the rental payments. Here, 80GGA. Okay. Then you have 80GGB, 80GGC, 80GGC. Okay. So these are the deductions and this is rent payment under section 80GG. So that we'll cover it separately. Fine. So first is section 80G. Now 80G is the donation, deduction for the donation to certain funds, charitable institutions. So just write down 80G, deduction for donation to funds or charitable institutions. Fine. So this is applicable to an individual who is not going for 115 BAC. Okay. So only if you do not exercise the concessional tax regime, whether for the individual or for the companies also when they are going under, not going under 115 BA, BAB, BAD, BAE, all of that. So this is applicable to all the assessees, whether individual, HUF, corporate, non-corporate, everybody, but they should not just exercise the concessional tax regime. Now there are different categories of deduction. There are certain categories of deduction. First is where 100% deduction is available without any qualifying limit. Then there are 100% deductions subject to qualifying limit. Subject to qualifying limit. And then there are 50% deductions without qualifying limit. And again 50% subject to qualifying limit. So what is this qualifying limit? First of all, we'll understand that before we decide which are covered under 100%, which are covered under 50%. What is this qualifying limit? Now the donations should be aggregated, which are subject to the qualifying limit. And the sum total should be limited to 10% of the adjusted GTI. So I'm just putting it here, A, B, C, and D. So basically, for the purpose of the qualifying limit, the B plus D donations. Okay, donations under B plus D which is 50% or 100%, which are subject to the qualifying limit to the extent of which is less than 10% of adjusted gross total income. So the maximum deduction, the qualifying limit is the maximum deduction which is available will be the 10% of the adjusted GTI. So donations under B plus D should be less than 10% of the adjusted GTI. That's the maximum deduction. Now, here also the deduction under 100% category, will be first allowed from the maximum permissible deduction, and then 50% category shall be allowed. Okay, fine. So what will be your step one? Your step one is to find out the adjusted gross total income. What is my adjusted gross total income? So adjusted gross total income means GTI less Chapter 6A deductions other than ATG, less STCG under section 111A, less LTCG under section 112 and 112A, less exempt income, less special income or income taxed at special rates, which is section 115A, which is in the nature of the dividend, interest, royalties, right? So 115A 1A, which is basically my dividend income. Just write it instead of 115, just write down in 115A1A, which is dividend interest royalties FTS. Okay. Next is 115AB. 115AB was these foreign incomes which are there for the bonds which are there, specific bonds, right? Offshore bonds which are there. So again, 115AB is for that. Units purchased in foreign currency. 115AC is for the ADR, GDR. 115AD is for the FIIs. And 115D is again in respect of the mutual funds and the bonds. Okay. So basically, these are all the foreign incomes. Clear? That will give you the adjusted gross total income. So the step 1 is compute the adjusted gross total income. Your step 2 is adjusted GTI into 10%, right? Step 3 is the total of donation under 100% and 50%, which are only subject to qualifying limit. So not all the deductions, not all the donations under ATG, but only the 100% 50% which are subject to qualifying limit, which is B plus D, right? And then your step 4 is first lower of 2 or 3. Lower of 2 or 3 is maximum deduction. And step 5 is first allow 100% deduction category, 100% category against maximum deduction and then 50% category. Yes or no, students? Is it clear? Okay. So this is how your qualifying limit is calculated. So qualifying limit, there are certain deductions which are eligible only for the qualifying limit, either under 50% or 100% category. But you allow the maximum deduction for those donations up to 10% of adjusted GTI. Adjusted GTI is my total income, less Chapter 6A deductions, except ATG, less my short-term, long-term capital gain, 111A, 112, 112A, and any exempt income, and of course, the special incomes, or the incomes which are taxed at a special rate. Fine. Now, under the 100%, without any qualifying limit, all the ministers' deductions which are there, like the Prime Minister's National Relief Fund, Prime Minister's Earthquake Fund, National Children Fund, Chief Minister's Earthquake Fund, or the state government's fund which are there, or any government funds which are set up. So all of that are covered under 100%. So you can just write it over here. You cannot remember all of that. So PM funds or the government funds, they are subject to 100% deduction without any qualifying limit. You cannot remember all, but you can at least identify based on this. Under the 50% without any qualifying limit, there is only one, which is Prime Minister Drought Relief Fund. There's only one under 50% without qualifying limit. Under 100% subject to the qualifying limit, the contributions to the government or any other local authority for the promotion of family planning. So again, here there are two: contribution to government or local authority for family planning, and secondly, sum paid to Indian Olympic Association. Indian Olympic Association for the promotion of that sport or for the development of the sport or for the sponsorship. So only these two are eligible for 100% with qualifying limit. Now what is coming under 50% subject to qualifying limit? Any other deduction to any other donation to any charitable institution or any fund which you see under 1023C, 12A, 12B, if any charitable or religious institution is there, that will get covered under 50% deduction. So, donation to funds or charitable institution. Okay? So, for them, it is 50%. Here you can write one more, Clean Ganga Fund. This is usually asked in exams, so I'm just writing it. So see, most of them, the whatever national funds, PM funds, government funds which are there, that is 100% deduction without any qualifying limit. For the qualifying limit, only you have two, which is for the Olympics and secondly for the family planning. Those are only for the 100% subject to qualifying limit. 50% without any qualifying limit is PM drought relief fund. Then rest of them will fall under automatically 50% subject to the qualifying limit. Are we getting that? So for others, to whomsoever you are contributing to any fund or institution or to even government or other than these purposes, then that will be covered under 50% with qualifying limit. Are we getting that? But these 50% with qualifying limit, so that these institutions and the funds which are there, which are the charitable in nature, these should be established in India for charitable purposes. These should be established in India for the charitable purposes. So in India, these should be the charitable institutions basically. So their income should be exempt under 1023C, 11 or 12 section. Are we clear? Then these income that they earn, these should be excluded by virtue of the 1023C, 1023AA, 11 or section 12. Okay? Then if they make the non-compliances, then of course these funds will not be eligible for ATG registration, and therefore the deduction you make to them will not be allowed to you as deduction. Okay, so if these funds non-comply with any of the conditions of 1023C, section 11 or section 12, then the donation that has been paid to them will not be eligible for the deduction. Because if you make them the donation and then they do not comply with these conditions of 1023C, or they are making some related party payments that we learn in section 13 of the charitable trust provision, right? So in that particular case, these will not be eligible for deduction. Okay. So these basically funds should operate only for the charitable purpose and not only for the religious purpose. This should not be only for a religious nature. This should not be, the charitable purpose will not include the purpose or the whole or substantial of the whole of which is of religious nature. If there is a religious trust which is promoting only one particular religion, for that there will not be any deduction. Of course, they can make some small religious contribution, but they cannot just benefit only one particular religion. It should be for a charitable purpose. Are we getting that? And plus, these funds should file the statement of the donation received. These funds should file the statement of the donations received to the income tax authority and should also furnish the certificate to the donor. So, the funds should first of all file the statement to the income tax authority that we have received the donations from so and so person, and should also generate a certificate and give to the donor. Because earlier what used to happen, these funds basically used to just, do the cases of money laundering. They just used to collect, even the assessees just used to pay, claim the fake deductions, everything was fake. So therefore, they have mandated the fund or the trust to file the statement of donation and furnish the certificate to the donor. Okay, any questions, any doubt? Any questions or any doubt? Yes, student. Okay, just write it over here. Funds or the trust should operate for charitable purpose, not for wholly religious purpose, should be registered under section 80G, furnish statement of donations, furnish certificate to donor, satisfy section 11, 12, 10, 23C conditions. Fine? Yes or no? Yes, students. Then last one point, donation in cash allowed up to rupees 2,000. So donation in cash allowed only up to rupees 2,000. Fine. The next section is 80 double GA. Now what is 80 double GA? Section 80 double GA. This is deduction for in respect of scientific research, donation for scientific research or rural development. So this is basically for the assessee. Here the eligible assessee is assessee not having income under the head PGBP. Why? Because for PGBP, there is a deduction under section 35. So if the assessee has the income under the head PGBP and if he makes the donation to such scientific research organizations, he can claim obviously the deduction under section 35. So therefore, this is for somebody who does not have the income under the head PGBP. And what are the donations, qualifying donations? Same as 35. Same as section 35. Which ones? Some paid to the research association where the object is of the scientific research. So, some paid to scientific research associations or university right? Or college for scientific research, or some paid to the any university or college for the social science or statistical research, some paid to uni, college or research association for social or the statistical research. Then some paid for rural development, some paid for the rural development to any institutions or association which are undertaking that, right? Or to any local authority. So this deduction will be available to an assessee when he is paying the sum to these particular institutions. Are we clear? So this deduction will be allowed only when the assessee does not have the PGBP income. Are we clear? Here also you can write donation in cash up to rupees 2000. Okay, donation in cash only up to rupees 2000. Clear? Next is 80GGB. 80GGB is deduction in respect of contribution given by companies to the political parties. And 80GGC is basically the contribution by the any person to political party. So 80GGB and GGC are parallelly going. So I'll just write it over here, GGB. Here I'm writing GGC. Here my eligible person is. So in case the question in the exam says company, you will apply 80GGB. Here you will apply if there is any other person. So then you will apply 80GGC. Okay. So under 80GGB, what is the deduction and the contribution for? What are the conditions? So the condition is that contribution for the political party. Okay, so contribution meaning any donation to or any subscription by a company to a person carrying on any activity which is going to support the political party, or any expenditure incurred by a company on advertisement in publication which is souvenir for the political party. So if you remember under 37(2)(b), deduction for the expenditure for advertisement in any souvenir for the political party is disallowed as an expense. But you can get deduction under 80GGB and GGC. So deduction is for donation or advertisement in magazine or souvenir. Okay. Then donation should not be in cash. The donation should not be in cash. Under 80GGC, it provides for deduction of any sum which is contributed to a political party. This will be available to any other person. So individual HUF, AOP, BOI will be eligible under 80GGC other than company. So it is same, donation or advertisement in magazine or brochure. Donation should not be in cash. Okay. Yes, students, any questions, any doubt? Now the last only one remains 80GGA, which is deduction for the rent payment. which is deduction for the rent payment, which is under 80GG. So just write down deduction for rent paid, 80GG. Now this is for the eligible assessee is assessee not receiving the HRA. So means if the assessee receives HRA, he qualifies for the exemption under 1013A, right? Assessee receiving HRA, then the exemption under section 1013A will be applicable. Because then you are an employee, you have the chargeability under income from salary. Okay? From the employer. So what are the conditions? The assessee should not be receiving no HRA should be received. The assessee should not be receiving any HRA exempt under 1013A. Okay. Then the assessee should have incurred the expenditure on the rent. Incurred rentals for either furnished or unfurnished house. The accommodation should be occupied by the assessee for the purpose of own residence. For own residential house. Or for own purpose, you can write. For own incurred rental for own purpose. Okay. The assessee or the spouse of the assessee or his minor child or the HUF of which he is member should not own any accommodation at the place where he is residing at the moment. Okay. So, assessee or the spouse or the minor child or the HUF should not own accommodation at place where he resides. Where he resides or perform his business or employment. Okay? Because otherwise people will misuse 80GG. They will claim they will have the same house in the vicinity and still they will claim 80GG. Under HRA, there is no similar provision. So even if you have a same house in the same city, you can still claim HRA. So let's say I have a house and plus I'm staying on rent. I can claim HRA. But if I have a house and I'm staying on rent in the similar area, I cannot claim the HRA. I cannot claim 80GG. So here you can write no similar provision in HRA under section 1013A. So if I am getting HRA, then if I have own house in same area plus staying on rent for HRA allowed under section 1013A. For the 80GG, this is not allowed. Fine, this is not allowed. Then the last condition is that the assessee, if at all he owns any accommodation at any other place, that such accommodation should not be in the occupation of the assessee. Then the assessee should not have the occupation of that particular house. Let's say, for example, I am in Bombay and I have the accommodation, let's say in Surat. But that one I should not be occupying. I should be occupying the Bombay house. Are we clear? So that should not be basically a self-occupied property. What they are trying to say, I should not have a self-occupied property in the similar situation. So just write down, or a deemed let out property. So if any accommodation is owned by assessee at any other place, that should not be a self-occupied property or a deemed let out property. So meaning it should not be a self-occupied property. In case it's a self-occupied, if let's say I have the limit of 2 houses to be taken as self-occupied property. But if more than 2 houses are there, it will be automatically treated as deemed let out. So it should not also be a deemed let out property. Okay. So it should not be the self-occupied property or the deemed let out property. Now what will be my deduction over here? The deduction shall be lower of a rent paid minus 10% of total income. Rent paid minus 10% of total income. 25% of the total income before, okay, then 5,000 per month. So lower of this will be deduction under ATGG. The point here is that you should not be claiming the deduction exemption under 1013A. You should not be getting HRA from your employer. If you get HRA, you go to 1013A. If you do not receive HRA, you come to ATGG. But you should not have house in the same area. If you have house in another area, you should not be having the same self-occupied or DLOP of that house. Clear? And in fact, your spouse or your minor child also should not have any house in that area. Namrata, you will have to remember this limit. There is no other way to, ease the way out or give you a simplified way where I can tell you that how will you remember. You will have to just remember by mugging up this particular limits which are given. Okay. So thank you so much, student. In the next session, we will be covering the profit linked deductions. Okay. So thank you so much. See you in the next class. We can close the session.